gold is going to 10,000 by 2030. How do we know that? That's because commercial banks made gold money again by making it tier one capital. There might be some short-term scares if there is any kind of credit or liquidity crunch. I don't expect gold and silver to go down. Well, silver is tied to the economic cycle, and I'm bearish on the global economy. It was due to liquidity raising. People sold what they could, not what they wanted to. Turkey sold, I think, 120 tons of gold to raise liquidity. $125 oil, 5% inflation by May. I thought the bubble was popping, quite frankly. Prior to the war, we were starting to see the complex wobble of private credit was getting hit. Michael Burry's come out and said that, NVIDIA and all these other people are committing off-balance sheet fraud. It's legal, but the risk is being put elsewhere, and it all is a house of cards. I mean, the stock market is not the real economy. 45% of your market cap is AI, and there's no profits yet. Where do you invest? You're investing in future hopium. The housing market is rolling over. In the stock market, we were early, but I wouldn't touch it here with your money.
I want to start things off today with discussing precious metals markets, because since hitting all-time highs near the end of January this year, both gold and silver, of course, have corrected and are now in a sideways consolidation. Do you think the next move from here is to the upside or to the downside? Obviously, that's the $10 million question. And what are the factors you see currently driving precious metals markets?
Well, I was bullish precious metals last year in 2025. Had a near-term price target of 4,000, and it exceeded that. And over the last 6 months, I've been asked a lot about gold and silver, and my long-term viewpoint is that gold is going to 10,000 by 2030, and that's due to a host of factors we all know about: central banks buying, potential new monetary system coming, the date of which is very uncertain. Gold is going to be a part of that. How do we know that? That's because commercial banks made gold money again by making it tier one capital. We have, retail investors in China and India, voracious appetites for gold and silver. So the fundamentals are there. But there was a tremendous move over the last 2 years into the top in January of this year. And I said then that I expected to consolidate, and that's what it's been doing. And that's healthy. Gold is not showing signs of a parabolic top, meaning it's already down 40%. So this is quite healthy. Silver is a little more volatile. It is an industrial metal. So I expect them to continue to consolidate.
Markets are obsessed with the next gold breakout while ignoring the fact that healthy bull markets spend most of their time frustrating investors. Edward Dowd notes that central bank accumulation, tier 1 treatment of gold, and persistent Eastern demand remain intact despite the consolidation. The overlooked signal is that speculative excess has cooled without destroying the long-term trend. For wealth preservers, that matters far more than daily price swings or media narratives about momentum. Next, Edward Dowd reveals why a geopolitical crisis failed to launch gold higher, and what that contradiction may be signaling beneath the surface.
There might be some short-term scares if there is any kind of credit or liquidity crunch. I don't expect gold and silver to go down. Well, silver is tied to the economic cycle, and I'm bearish on the global economy. But I wouldn't worry about gold and silver if you're a long-term holder. If you're trading it, flip a coin. If it's going to go up or down, I just think it continues to go sideways, and that's actually the healthiest thing. If your long-term target, like I have, is 10,000, after a big move like this, and you consolidate, the longer you go sideways, the more confident you are you didn't put in a parabolic top.
I'd love to get your thoughts on gold and silver's price action in the midst of this war in Iran, because I've spoken to a lot of different analysts, and some have said that this is normal. In a time of global conflict, there's a rush for dollar liquidity. And so in that case, you often see countries, governments, corporations, retail investors as well, for whatever reason, liquidating their physical gold holdings in exchange for US dollars. Is that how you see things, the way that they've played out so far? And if this war continues to drag on, do you think that trend could reverse somewhat? We could see that safe haven status for gold in particular kick in and perhaps cause a price move to the upside.
Yeah. So, there were when the conflict started, people were surprised by the price action in gold. And mind you, it's still consolidating. It didn't drop precipitously.
Gold didn't surge during a major conflict, and that's exactly why investors should pay attention. According to Edward Dowd, periods of stress often create a scramble for liquidity, where participants sell what they can, not necessarily what they want to. That breaks the simplistic media narrative that war automatically means higher gold prices. The deeper issue is whether confidence in fiat systems weakens after the liquidity panic passes. Next, Edward Dowd exposes how emergency liquidity needs can temporarily overpower safe haven demand, and why that reversal may arrive suddenly.
It was due to liquidity raising. People sold what they could, not what they wanted to. And Turkey sold, I think, 120 tons of gold to raise liquidity. So just like some of these top analysts you've talked to, that happens. Right now, the market, the stock market and the oil markets are discounting a resolution to this war. That's what they're telling you. And we put out two scenarios when the war started on the price of oil and what inflation might do, at least short-term headline inflation. And one scenario was $125 oil and 5% inflation by May, and then we get a resolution, and then inflation starts rolling over, and we continue our, what we were seeing was an economic slowdown, and the oil price shock only adds more pain. Delayed, there will be problems going forward. If we do not get a resolution soon, there are executives from Exxon and other oil companies talking about we're approaching in 2 to 3 weeks the bottom of some reserves around the world, and that oil will spike up, and some are predicting $150 oil soon. If that were to occur because there's no resolution to this crisis, gold may go up. I don't know, but it'll definitely shock. The yields will spike again temporarily, and I think this equity rally, which has been 100% AI, will falter and correct. And I still think the equity markets still have a lot of risk. I wouldn't touch this market with your money. We're seeing unprecedented, Five Sigma things going on.
The market is pricing in peace before the conflict is actually resolved, and history shows that assumption can become very expensive. What Edward Dowd is highlighting is the narrow path investors are betting on: lower oil, cooling inflation, and uninterrupted risk appetite. If oil pushes toward $150 instead, bond yields, corporate margins, and consumer spending could all come under pressure simultaneously. That's the kind of chain reaction most portfolios are not built to withstand. Next, Edward Dowd unravels why today's AI-fueled equity rally may be far more vulnerable to an energy shock than investors realize.
All sorts of signals that we see at tops, but again, it could go higher. I suspect the market is going to stay kind of elevated until the IPOs come, and then we'll see what happens. A lot of supply is coming, and a lot of the Mag 7 that used to do stock buybacks because of their CapEx spend won't be doing as many stock buybacks. So I think we're in the end stages of a lot of things. I actually would prefer to see the Iran war. Look, I'm bearish on the economy, but I don't want to see this dragged out, just so that I can be right. So enough damage has already been done, and I want to see this resolved, because if it isn't resolved, the oil markets and the stock markets are discounting it's already resolved. So it better be resolved.
45% of the S&P 500 market cap is AI or AI adjacent. We've got a storm of controversy emerging now over data center buildouts in the US, along with some reports that perhaps AI isn't going to completely take over white-collar jobs and revolutionize the economy the way that many have been promoting it. How big is the risk here when it comes to the AI segment of the broad market? And what could the aftermath be, assuming this AI bubble pops? You said you feel like we're in the end stages at this point.
Yeah, look, I thought the bubble was popping, quite frankly, prior to the war. We were starting to see the complex wobble private credit was getting hit. The war actually, I think, kind of gave one last leg of life to it, because the only thing that's working right now are AI stocks and earnings.
When nearly half the market's value depends on one theme, diversification becomes an illusion. Edward Dowd's argument suggests that AI is no longer just a growth story, but the pillar holding up broader equity sentiment. Meanwhile, rising capital expenditures, weaker buybacks, and growing questions around infrastructure economics are quietly changing the risk equation. Investors chasing headline winners may be ignoring how concentrated this market has become. Next, Edward Dowd reveals why the strongest performing sector could also be creating the biggest hidden vulnerability.
But the earnings are all circular. Free cash flow is going the wrong way. There's a lot of controversy, as you know, about the AI complex. And Michael Burry's come out and said that, NVIDIA and all these other people are committing, off-balance sheet fraud. It's legal, but the risk is being put elsewhere, and it all is a house of cards. Right now, what I'm seeing, I've been doing this a long time. What I saw with the semiconductor after the low put in early April, the semiconductors are up 80% in like 9 weeks. Semiconductor index. I talked to professional investors. There was a reason for it, because there was a demand surge, and then there was people worried and pre-ordering for helium shortages and whatnot. And then of course we have the speculation going on in the Korean market. 50% of their market cap is two stocks, Hynix and Samsung. These are ending moves. When you see this kind of speed and people chasing, and no more, we're just getting signals of all sorts of things we haven't seen that are most likely ending moves. But again, I'm not calling a top. I'm not telling people to short. I've always been on this of the mindset: you have dry powder in your portfolio. You raise some money, and that's personal, up to you whether you want 20% cash, 25, 50, and then when the correction comes, and it will come, I was less bearish last year. I thought we might get a slow decline of 40 to 50% over 2 years.
If this pace continues for another quarter, many investors may discover they own momentum rather than value. This is where Edward Dowd's thesis shifts from optimism to caution, as semiconductor shares surge at a rate often seen near speculative extremes. The real concern isn't the technology itself, but how aggressively expectations are being pulled forward. Preserving capital sometimes means resisting the pressure to participate in every rally. Next, Edward Dowd exposes the inventory and demand dynamics that have preceded painful reversals in past technology cycles.
This kind of action is crashy to me, meaning we'll put in a top, we'll have a drawdown, then we're going to counter trend rally, then we could get a crash. I'm not calling for a crash, but the risk for a crash is a lot higher now because it's so concentrated. And, semiconductors are notoriously cyclical. It's an industry that, has booms and busts. That hasn't changed. And it's now 18% of the S&P 500 index, the semiconductor industry. It's 30% of the NASDAQ. And I've done this, over and over again. We're starting to hear whispers of double ordering because purchase managers, need to get their allocations so they can make their products. So they about 6-7 months ago, they started asking for 500. Let's say you ask for 500,000 units and you say, oh, we can only give you 250. Well, then the next time you order, you double your order and say, so the backlogs look way better. There's a lot of enthusiasm, but when the supply and demand meet, there's inventory buildups everywhere, and that's what's going to happen. It always happens. So I'm just very cautious on this market, and given the global risks and the oil price shock that's working its way through the economy, margins are going to get squeezed in the non-AI sector of the economy, which is the real economy. I mean, the stock market is not the real economy. 45% of your market cap is AI, and there's no profits yet. what are you investing? You're investing in future hopium. You're not investing in actual earnings and growth. Now,
this exact combination of concentration, inventory optimism, and speculative enthusiasm has appeared near multiple market peaks over the last 3 decades. As Edward Dowd points out here, semiconductors now represent an outsized share of major indexes, while whispers of double ordering suggest demand may be overstated. Wall Street celebrates backlog growth, but rarely asks whether future demand is simply being pulled forward. If inventories build while economic activity slows, investors could discover that projected earnings were built on assumptions rather than reality. Next, Edward Dowd reveals why the AI narrative may be colliding with physical constraints that markets are still ignoring.
People are speculating it's going to turn in earnings and growth. And as you mentioned earlier, there's all sorts of questions of data center delays because of opposition, not enough power on the grid anyways. And now Bloomberg came out with a story today. Bain, a consulting company, said there is no ROI, it's a bust. So, the markets can continue to be irrational and go up on this, but the narrative is changing fast, in my humble opinion.
In the aftermath of this bubble popping, I mean, in terms of picking up the pieces, would you be cautious there as well? Many could imagine that they'd be catching a falling knife in such a scenario. And I've spoken to some people. Dave Collum comes to mind, who says we could be in for a decades-long grind sideways after a precipitous drop in the broad market, perhaps similar to what the Nikkei did for several decades. Do you think that's a possibility? At what point would you start looking for bargains in that type of scenario?
Well, that's difficult. What we don't know is I do think there'll be a 30 to 50% decline. And I say I'm hoping for 50. I say 30 because the policymakers may not allow the stock markets to fall that far and may come in with bazookas. I don't know because I don't know what the bazookas look like yet. So you have to kind of call it in real time. So right now, I'm cautious. I would not put any new, fresh money to work in the stock market at these all-time historic valuations.
Markets keep pricing AI as if future profits are guaranteed, yet the infrastructure required to generate those profits remains deeply uncertain. Edward Dowd notes that power shortages, project delays, and mounting questions about return on investment are beginning to challenge the dominant story. The contradiction is obvious. Investors are valuing outcomes that may never arrive on schedule. For wealth preservation, the danger isn't missing upside. It's assuming policymakers can always rescue inflated valuations. Next, Edward Dowd unravels why government intervention may not prevent losses if confidence breaks before liquidity arrives.
Warren Buffett himself is 40% cash. His stock has underperformed the S&P 500 the last year and a half. That typically happens before major market corrections because he starts accumulating cash into the top. And he's got so much money, he doesn't call the top, but he's been cautious like we have been for 2 years. We've been early and wrong on the stock market, but not wrong on the rest of the real economy. The real economy is in tatters. The housing market is rolling over. And we've been right on our call on gold. But in the stock market, we were early, but I wouldn't touch it here with your money. And very cautious. I've done this a long time, and here's another indication of how crazy it is. An old video of Trump talking about IBM in December recirculated on Thursday, and IBM's up 30% over the last 2 days as a result of an old video. Yeah.
That is completely insane. I want to talk about the real economy now because David Rosenberg was recently on CNBC where he stated that real incomes are decaying, but spending is holding up only because the savings rate dropped from 5.5% to 2.6% in a year. Talk about this disconnect between Wall Street and Main Street and what the ultimate result of this K-shaped economy will be.
Well, so it's gotten so bad now that the top 10% of the consumers are responsible for like 49% of all the consumer spending. So there's a small cadre that are continuing to, go about their lives and very comfortable in their lifestyles, while the rest of the population is struggling mightily.
Warren Buffett, sitting on massive cash reserves while markets celebrate record highs, should make investors ask harder questions. According to Edward Dowd, the real economy continues weakening even as asset prices project confidence and prosperity. The overlooked signal is that consumer spending is becoming increasingly concentrated among a shrinking group of households. When wealth concentration drives economic activity, markets can appear healthy long after underlying conditions begin deteriorating. Next, Edward Dowd exposes the consumer credit trend that mirrors warning signs seen before previous economic downturns.
And we know that because we see credit card delinquencies rising, car loan delinquencies rising, and now we're starting to see mortgage delinquencies rising. So at some point, that will affect everything, especially credit. And they're drawing down their savings and they're putting what they can on their credit card. And this can't go on forever. And with the oil price shock, this is what happened in 08. Same thing was going on in 08. And there was a small mini oil price shock. People don't remember it. It's all housing and people remember the big short. But I remember oil going to 140 from like $70 over a 5-month period. It was a mini oil price shock, and that wiped out the consumer in the second half of 2008. And inflation did rise going into that, headline inflation. Then it rolled over when the recession hit.
The biggest risk may not be what investors are watching, but what they're dismissing as temporary consumer stress. What Edward Dowd is highlighting is a pattern of rising delinquencies across credit cards, auto loans, and mortgages. At the same time, savings are being depleted. Financial media often frames consumer spending as resilient, yet borrowing to maintain lifestyles is not the same as sustainable demand. For long-term investors, deteriorating household balance sheets eventually surface in corporate earnings and credit markets.